Rate cuts, mortgage stress, and unemployment. It looks like the economy is actually starting to turn over, and some big banks are now coming out also suggesting that rate cuts are on the cards. In this video, I want to have a conversation around what unemployment looks like as of this morning, so I'm not sure when you're watching this, but this is live data that has just come out today, and how this could play a part in the housing demand and supply issue that we're seeing right now in Australia. If you're interested in what my thoughts are, then definitely keep watching. Hey guys, my name is Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, CBA, the largest Australian bank here, has come out and suggested we have reached the terminal rate. The peak of the rate hiking cycle, it's done. And they've come out and also suggested when they think the exact dates would be around a rate cut and how many rate cuts we could see over the next 24 months. So let's discuss that before we jump into what's happening in the economy and why the biggest bank in Australia is now suggesting rate cuts is a thing. Rate cuts coming to help mortgage-stressed shoppers, CBA says. Consumer spending across New South Wales and Victoria is tumbling under the weight of supersized mortgage repayments, and the nation's biggest lender predicts the Reserve Bank will need to slash interest rates a full percentage point to stabilize the economy. Ahead of the release of these figures, which could show wages growing faster than inflation for the first time since the lockdowns in 2020, a new measure of household spending compiled by the Commonwealth Bank shows consumers struggling to make ends meet. I've come out in previous videos and suggested that although shopping centers are busy and restaurants are packed, it may not necessarily mean that people just have a lot of money. They may be going and dipping into their savings, using credit cards to just get basic necessities. Now, I'm not saying going to a cafe to have a coffee is a basic necessity, but then I could also get smashed in the comment section going, dude, I can't go without my coffee a day. CBA's new household spending index, based on expenditure patterns of 7 million people collated through cards, accounts, and electronic payments, was flat in July to be up by just 1.3% in the past 12 months. During that period, inflation was 6%, pointing to a substantial drop in real expenditure. CBA chief economist Stefan said the index reflected the effect, the 4 percentage point lift in official interest rates imposed by the Reserve Bank since May last year. In the states with the highest average mortgages, New South Wales and Victoria, spending at the annual rate has fallen by 0.2% and 0.3% respectively. Spending is holding up in areas with the smallest mortgages, including South Australia and Western Australia. Monetary policy is now restrictive and financial conditions will continue to tighten in the months ahead on the lagged effect of RBA interest rate increases and the fixed rate mortgage refinancing task, he said. We continue to expect household spending to weaken further through the remainder of 2023 and 2024. He said he expected the Reserve Bank, which took the cash rate to an 11-year high of 4.1% in June, would cut rates by a full percentage basis point next year, being 2024, and he also predicted 2 further rate cuts in the first half of 2025. A percentage point reduction in the cash rate would save a household on a $600K mortgage about $400 in monthly repayments. So to summarize all of that, we've got retail spending down, we've got people spending a lot less just in general across Australia, and that is mainly because the mortgage is taking a greater portion of our income left. So less disposable income, meaning people can't go out there and spend as much. This is the design of the monetary policy. It's to slow down how much consumption is happening. But the problem is that interest rates take time to come into effect. And so if we're finding the effects right now, we're really only feeling the ones from maybe 3 or 6 months ago. So any of the rate hikes that we've seen probably since April have yet to really see the full effect in the economy right now. So the official cash rate at the moment is 4.1%. So if we see a decline from that point, which is being suggested at 100 basis points, you're looking at a cash rate of about 3.1%. Now, if you actually go further ahead into 2025, as this economist at CBA is suggesting, then you're probably seeing another 50 basis point decrease. And that would mean that the cash rate would sit in and around sort of 2.6 to 2.7%. That does make the most sense because you usually want that number to be very closely linked with what your inflation actually is. And we know in Australia, the inflation target is between 2 and 3%. So getting it to about 2.5% makes a lot of sense. However, I think these rate cuts will come a lot quicker because when you increase rates so quickly, if all goes well and you have a soft landing, then yes, this could make sense. But I don't think we're going to have a soft landing. I think we're going to have some sort of turmoil, whether that's in Australia or overseas. We're already starting to see some cracks in the Chinese economy, and that'll have major effects on what happens here in Australia. So as those interest rates increase, you start seeing a lot more pressure, not just on consumers, but also on businesses. Because businesses have been affected by the fact that they're sourcing all the resources that they need to produce the services or goods they sell, that's actually increased. They're trying to flow that on to the customer. So that's why you go out and you say, oh, coffee's costing a lot more now than it did before. But that's not necessarily because the cafe owner is making more money. It's just that their cost increased, so they're now going and pushing those increases to the consumer. But if the consumer stops buying buying, you're going to start seeing that effect on the cafe. And the cafe might go, well, I can't afford to have more staff. That means I need to get rid of the staff because we don't have enough demand. And when you don't have enough staff, you start seeing unemployment go up. And that's exactly what happened as of this morning. We've seen 14,600 jobs lost in the last month. We've seen Australia's unemployment rate jump from 3.5% in June to 3.7% here now in August. The more concerning thing here is the underutilization rate, which comes in at 10.1%. That's the highest it's been since March of last year. One of the things that have been noted by the governor here in Australia, by Philip Lowe, he has said that we need to see that number closer to about 4.6%. But because we know the environment is so different now than it was, say, a year ago, or even in the last 5 years, we know that it doesn't necessarily need to be at 4.6%, especially if everyone's spending just reduces a hell of a lot. We have so much more debt in the system, so an increase of 1 percentage basis point on your actual mortgage is having a larger effect now than it did 10 years ago. So when it comes to inflation, I think we've seen the peak here in Australia, but that doesn't mean we're out of the woodworks yet. I think the RBA is going to hold their position in September, just see some more data come through before they actually go ahead and make that decision whether they're going to pause for the next 3 months, seeing out the rest of the year, or if they're going to go in and actually start cutting rates. According to CBA, they think the rate cuts will start in March of 2024, which is a little over 6 months away from now. Now, a major issue here in Australia is obviously the housing crisis. Now, what we are seeing is that it's not just about supply, just trying to build new homes. It's also the demand side. Are there people willing to go and build a new home? Are they willing to take on that risk? And as a developer, are you really wanting to commit to something when there's a bit of uncertainty around where interest rates are, how many people can afford to actually build now that can actually complete, and how many will go on to cancel their contract? What this graph is showing is the new owner-occupier dwelling commitments, and you can see it completely fall off over the last 24 months. These are some levels that we haven't seen in over 5 years. And when it comes to borrowing constraints for aspiring first home buyers, what we're seeing is that there's only 11.2% that aren't constrained by borrowing concerns. When it comes to the majority, which is 65% of people, are feeling that both constraints are binding when it comes to repayments as well as the down payment. So there's two components. If you can get one right, you're probably going to struggle on the second. And if you get the second right, you're probably struggling with the first. That's the reality at the moment for anyone trying to buy a home, is that you could work your way to saving all this money, but can you actually make the repayments? And maybe you can make the repayments, but you just don't have enough money yet to buy the property. I'm in line with the thinking that the RBA's next move is going to be a cut more likely than it's going to be a hike. At this point, we're probably going to pause for a few months, just see how the economy is actually faring. And unless something breaks in China or here in Australia, we're probably not going to see a rate cut at the next meeting. Keeping all this in mind, what are your thoughts? Let me know in the comments down below what you think happens next to property prices as they've started to rebound quite considerably. And if we pause again, does that not just put more fuel to the fire? I want to know what your thoughts are. Let me know down below. If you guys have enjoyed this video, smash that like button, subscribe if you haven't already, and I'll catch you guys in the next one. Thanks, guys.